Hello guys, so welcome back to one more interesting session. And इस session में we shall be discussing much more upon the valuations of the financial companies. And as in the previous session, we were talking about a few of the methods of DCF modeling or the discounted cash flow analysis. We shall go one step further towards understanding much more. And in the previous session, I remember we were talking about the cost of capital, right? We talked about the cost of debt, we talked about the cost of equity, and we also talked about the cost of capital, the overall cost of capital or the weighted average cost of capital. So be यहाँ पे we shall be going deep dive into the cost of capital itself. I will just start sharing my screen as well. Just let me know if my whiteboard is visible, and we shall start understanding the same. So more or less, first of all, we shall start to understand about the cost of equity. That what exactly is cost of equity? Though in nutshell, we have already understood about these concepts, but from a practical perspective, from a conceptual perspective, it is something that we need to understand. And moreover, from a formula perspective also, right? That is how to calculate the cost of equity. तो हमने बात करी थी कॉस्ट ऑफ डेट की, राइट? कॉस्ट ऑफ डेट हमको पता है क्या होता है, राइट? इट इज सिंपली द इंटरेस्ट रेट दैट यू आर पेइंग अपॉन द लोन दैट यू हैव टेकन, or the debt that you have taken adjusted with the tax rate, right? So for example, if I have taken a loan worth rupees 10 lakh and the interest rate on that loan is 10%, so 10% is not exactly my cost of debt. 10% into 1 minus taxation is my cost of debt, right? So if my interest rate on debt is 10%, if my interest rate on debt is 10%, then my effective cost of debt should be adjusted with the tax rate. So if I come under, or if you come under the 30% tax bracket, so it would be 10% into 1 minus 30%. That is 0.30. So that is the cost of debt. There is no specific calculation कि cost of debt को कैसे निकालते हैं. It is simply a number, right? For companies who have taken debt from multiple organizations. So for example, if there is a company X and the company X has taken loan from various banks, plus, the company has raised money via bonds or debentures in the secondary market, and raising money from the public, from institutions, from mutual funds, from pension funds. For those set of companies, in the annual report, you tend to get something as a weighted average interest rate, right? Or the weighted average cost of debt, right? So that is the cumulative cost of debt, right? Because it's not mandatory that एक कंपनी ने सिर्फ एक ही जगह से debt लिया हो. The company raises debt via multiple sources, via banks, via some NBFCs, via raising some debts or debentures, or some different types of fixed income instruments, right? So the quality of the debt, the quantity of the debt, right, or the purpose for which the debt has been raised from varied organizations, it might differ from company to company, right? But simply you need not calculate this number. This number is simply given to you in the annual report in notes to account in the interest section. Even in the balance sheet, even for the balance sheet where the company has taken long-term loans, in the balance sheet section, in the long-term liabilities, you have the section for loans, right? The long-term loans. So if you go to the annual report in notes to accounts, again, that's a part of the very first session that we talked about. You have a separate section in the notes to account where the balance sheet gets decoded, the long-term liabilities get decoded, and we get to know from which sources the company has taken loan. How much loan the company has taken from HDFC Bank, for example, how much loan the company has taken from ICICI Bank, how much money the company, how much debt the company has raised in the market as a secondary issue for institutions, for people like you and me from the retail side, HNI side, and different set of people. So all the set of data you tend to get in that notes to accounts ka section. You get the quantity, quantum, as well as the rate of interest, and you also get a weighted average interest rate on debt. That weighted average interest rate adjusted with tax is your cost of debt. So cost of debt में कुछ खास कैलकुलेशन नहीं करनी है. It is straightforward. एक सिंपल नंबर है from the annual report. You just take that number, copy paste that number, and get the value. But cost of equity is something that we need to understand, because cost of equity is something which is not complex, not difficult, but a bit tricky. Right? There is a specific formula to calculate the cost of equity, and that formula is derived from the CAPM model. That formula is derived from the CAPM model. ठीक है। अब सीएपीए मॉडल क्या बोलता है? इट इज योर कैपिटल एसेट प्राइसिंग मॉडल फॉर ऑल ऑफ दोज हु आर द स्टूडेंट्स ऑफ कॉमर्स, हैव डन बीबीए और अ बीकॉम और अ बीकॉम ऑनर्स, बीएमएस, एमबीए later. Even if you are a science student but have done MBA, CAPM model is something which is taught everywhere. But if not, I'll try to simplify this model for you. I'll be just sharing a set of study material on the group itself after the particular session is over, and you shall be having the whole CAPM model's crux, deep dive analysis, and the understanding of the CAPM model, the advantages of the CAPM model, the limitations of the CAPM model, assumptions or the premises based upon which the CAPM model is being used. But just to tell you in general, or to make you understand to the point, the major crux of the financial modeling and valuation, because people won't be asking you the assumptions or the advantages and disadvantages of the CAPA model while you are making an equity research report or while you are making the company's financial model on Excel. But you should know what is CAPA model, because cost of equity is something that we get from a CAPA model only. You need to calculate that. The number will not be given to you in the annual report. जैसे कि कॉस्ट ऑफ डेट का नंबर यू गॉट स्ट्रेट फॉरवर्ड, जस्ट टेकिंग द नंबर फ्रॉम द एनुअल रिपोर्ट and copy pasting that. But cost of equity is something that you won't be getting directly. You have to calculate. And one thing also for cost of equity, my number for cost of equity might differ from your number of cost of equity sometimes based upon certain factors, right? There are a variety of factors based upon which the cost of equity might differ, but the difference in the cost of equity might not be so much, right? If I am calculating the cost of equity hypothetically as 6.5%, the other person might calculate the same number as 7% or 6.9% or 6.8%. The difference will not be much. But based upon certain premises or assumptions which I make and the second person makes, the cost of equities number might differ. And as I have been stating from the very first session, that financial modeling and valuation, or when we're trying to value a company based upon DCF modeling or RV method, RV stands for relative valuation method. वो भी हम करेंगे, हम समझेंगे बाद में. But the thing is, everything is based upon assumption. Your assumption might be different from my assumption, and that is why the final valuation of the company that we get at the end might differ. My valuation might differ from your valuation. Your valuation might differ from some other person's valuation. A person who is doing a valuation of a specific company A at JP Morgan, the number might differ at Morgan Stanley. For the same company, for the same time period, the number might differ at Motilal Oswal Asset Management, right? So, based upon the underlying assumptions, we need to understand and we need to have logic for the assumptions. If you do not have the logic for our assumptions, our cost of equity ka number is wrong. If different companies, if different equity research guys are giving you different numbers for cost of equity, they are not wrong. Everyone is right. They are wrong if they do not have the logic for their assumptions. If you can justify the assumptions because a couple of inputs shall be used to calculate the CAPM. If you can justify those couple of inputs, your number is absolutely correct. Justification is important in the field of valuation, in the world of equity research or financial modeling and valuation. अब CAPM क्या है? It stands for the Capital Asset Pricing Model. C stands for capital. C stands for capital. A stands for asset. P stands for pricing. And M stands for model. Right? Capital Asset Pricing Model. अब this asset pricing model is helping us to calculate the cost of equity. Now, as I told you previously, the cost of debt, if we calculate the cost of debt, right? The cost of debt is being denoted by K subscript D. D is below K. Similarly, your cost of equity is denoted by KE. Your cost of equity is denoted by KE. Now here, how do we calculate the cost of equity? The formula for the cost of equity is RF plus B into RM minus RF. Now here we shall try to decode each and every input or raw material which is being used to calculate this cost of equity. Because each and every input is very important here. We need to decode that input and that will take time. Right? So if we talk about this cost of equity, right? This KE, it represents cost of equity. It denotes cost of equity. It represents cost of equity. If we talk about this RF, right? So what exactly is RF? You guys can put up your questions in the chat box. Like once we are going ahead in the session, कोई भी doubt होता है, just keep on putting the questions. I'll take them ahead. ठीक है? Not to worry for that. तो RF क्या है? RF is your risk free rate. RF is your risk free rate. Now we'll try to spend some time upon the risk-free rate. What exactly is the risk-free rate? Then we'll try to spend some time upon the B component, then the RM component, and then the bracket, the RM minus RF. And that will take time. We shall go step by step and try to understand the concept. आज अगर सेशन में टॉपिक खत्म नहीं हो पाता, हम इसको एक्सटेंड कर देंगे नेक्स्ट सेशन में. But the concept should be clear, right? So what exactly is the risk-free rate? So as the name suggests, risk-free rate, it means no risk. A certain interest rate which has no risk, or a certain interest rate upon a fixed income security, because interest rate can only be paid upon a fixed income instrument, a bond, a debenture, or something else, right? So something which cannot default, or which is closer to default free, which has an almost probability of 0% default, right? So that is a risk-free rate. Now, which fixed income instrument can have a risk-free rate? So usually, if we talk about in markets, equity markets are risky. Equity markets are risky, though we tend to make a lot of returns in equity markets over a long-term period. We tend to make that return. We take that risk in the market. We know that equities are risky. We know that stocks are risky, but we still take that additional risk in the market because we know that equity can give us more than the fixed income, right? Over a longer term period, over a 2 year, 5 year, 10 year time period, equities in terms of stocks, I mean, be it listed or unlisted per se, like good quality companies, high growth companies, have always beaten or outperformed the fixed income returns. Now, when I talk about the fixed income securities, in fixed income securities, we talk about bonds, we talk about debentures, we talk about investment grade bonds, we talk about high yield bonds, we talk about treasury bonds, treasury notes, some kind of other government securities. So fixed income securities can be of the different types. But when we are talking about some corporate bonds, जब भी हम corporate bonds के बारे में बात कर रहे हैं, ठीक है, ignore as of now the treasury bonds. As of now, we're just talking about the corporate bonds, right? Now, if we talk about the corporate bonds, your corporate bonds can be bifurcated into two, mota mota, right? Though the sub bifurcation can be into many legs, right, and branches. But like mota mota, if we try to just bifurcate the corporate bonds, there can be two types of corporate bonds. One is the IG bonds. IG bonds को we call as investment grade bonds. Investment grade bonds. And then you have the HY bonds. HY bonds are the high yield bonds. Here IG stands for investment grade bonds and HY stands for high yield bonds. So as the name suggests, if I say investment grade bonds, it means those are good quality bonds in which you can invest. And how do we assess a bond is a good quality bond? That we do not assess. The credit rating organizations, like you have in India, you have CRISIL, you have ICRA, you have CARE, right? The top three organizations in India which provide the credit rating to all the fixed income securities, also to the government securities as well. But globally, we tend to talk about the S&P, we tend to talk about the Fitch, we talk about S&P, Fitch and Moody, राइट. तीन रेटिंग ऑर्गेनाइजेशंस हैं ग्लोबली जिनकी रेटिंग्स को बहुत माना जाता है. क्रिजल से भी ज्यादा माना जाता है, इकरा से भी ज्यादा माना जाता है, केयर से भी ज्यादा माना जाता है. बिकॉज इकरा, केयर एंड क्रिजल आर इंडियन ऑर्गेनाइजेशंस. Those are global organizations that are putting their eye upon the global corporates and governments. How much rating to give them based upon their quality and the probability of default or non-default. Correct? If the securities are superly secure, the chance of default is almost equal to zero, right? The grade would be, or the rating that will be assigned to them would be triple A or double A. If there is some chance of default, somewhat closer to B, a triple B, right? Some kind of junk bonds, kharab bonds, or some kind of speculative bonds, maybe not junk bonds, but a grade higher than the junk bonds, but the probability of default will be higher than the B grade. Then उनको हम C category दे देंगे. Then बहुत ही घटिया bonds, where the probability of default is superly high. Junk bonds, right? The category D bonds, correct? So different organizations have different categorization of rating. Some might give a rating as triple A, right? In some, I mean to say, in some different organization, the triple A ka rating might not be there. They might have some AA plus, they might have some AA minus, but A, B, C, D, it tends to remain constant. The variations of A, B, C, D are there. Like किसी ऑर्गेनाइजेशन में जैसे एस ट्रिपल ए माना जाता है, किसी में डबल ए प्लस माना जाता है, किसी में ए प्लस माना जाता है सिर्फ, राइट? बट ए बी सी डी इट टेंड्स टू रिमेन कांस्टेंट. So in a broader way, A is the highest rating, then B, then C, then D. Also, we know about like one more concept about markets, and that concept is common for equity or fixed income. If you are investing into a risky proposition, the higher the risk you take in the market, the expectation of the return is also high. Simple logic of finance. Higher the risk, higher is the expected return, not the actual return. Expected return. If you are investing into a Bitcoin, your expectation of return is much more higher than fixed income and equities. Obviously. Correct. So the how much risk you take in the market, your expectation for return also rises. Simple logic है. So if I invest into a secure bond, a triple A bond, high quality bonds, we tend to call them as prime bonds. Again, my expectation of return should be lower because those are safe bonds, high quality bonds. I'm taking closer to no risk in the market. I'm taking closer to no risk in the market. Then I will get something which is called as risk-free rate of return. The probability to default is almost zero. Not exactly zero, but almost zero. And in that category, you do not have corporate bonds. Corporate bonds are not risk-free bonds. There might be some category, they might land into a double A or a single A. But triple A category, superly prime bonds, right? जिनका डिफॉल्ट की प्रोबेबिलिटी ऑलमोस्ट जीरो है कि वो डिफॉल्ट होंगे ही नहीं होंगे. अगर होने की, if there is also, if some kind of a situation occurs that those high prime bonds can default, something will be done by that organization to not make them default. And that is your government bonds. Government bonds. In India, we simply call them as government securities. In US, we tend to call them as treasury securities. So we recently had the news, right, that the debt ceiling is getting breached year after year. US ka debt ceiling is getting breached. Now they stand at some $37 trillion of debt, right? $37 trillion of debt पे वो खड़े हैं. 36 trillion, $35 trillion of debt पे they had that debt ceiling raised, right? Because their bonds could default. Because their bonds could default, right? There was a higher probability that their bonds could default. Correct? Yes or no? पहले भी the debt ceiling has been raised. पहले भी the debt ceiling has been raised. Are you guys aware about that? पहले भी the debt ceiling has been raised. अभी भी हमारा $37.9 ट्रिलियन का डेट हो गया यूएस में. $37.9 ट्रिलियन का डेट. They have to service $1 trillion annually in terms of interest only. Here, I'm not talking about the principal component, just the interest component. Their debt is rising by $25 billion every day. Every day का उनका increase in debt, daily debt $25 billion, right? But every time they reached that debt ceiling, right, they increase their ceiling, they elevate their ceiling. And they say कि और आने दो, because like US is the cash printing machine, right? It's a global cash printing machine in terms of USD. It tends to export inflation everywhere. Tariffs are like one reason, but ignoring tariffs as of now, multiple reasons are there, right? We can talk about that in some general discussion session. So risk-free bonds are government bonds. But when the risk increases in the, so basically your government bonds or treasury securities will give you very less yield because those are risk free. But if you go towards a lower trajectory, you tend to go beneath. You tend to go towards a double a triple a A minus, a B category bond, right? Your risk increases. So when we talk about these investment grade bonds, just to give you a holistic picture, So when we talk about this IG bond, these are more of not triple A, but more of double A, right? Single A or B category bonds. B kabhi the highest B category bonds, but the interest rate will be higher. But if we talk about these HY bonds, high yield bonds, those are the more risky bonds. B ka lower category or C category bonds. And since investor is taking more risk to invest into the high yield bonds, the interest rate will be higher, much higher than the IG bonds or the treasury bonds. सिंपल लॉजिक है. ठीक है, तो इतना हमको आ गया समझ. बट द क्वेश्चन दैट कम्स इन टू प्लेस इज, आर द रिस्क फ्री बॉन्ड्स रियली रिस्क फ्री? कैन गवर्नमेंट्स default? Of course they can. There have been many examples of Greece, Argentina, right, whose government have defaulted. They have plainly defaulted. Now the economies have started to come back. They have been doing fairly well. But there have been instances in the past where the governments of many countries, maybe smaller nations or say mediocre nations, the governments have defaulted, right? And even if they do not default, and even if they do not default, correct, there's always a risk of duration. For all of those who are not well versed with the fixed income, I would recommend everyone to go via the modules on the website. Fixed income has been discussed extensively. Fixed income has been discussed extensively, right? So there is a concept of duration, right? It talks about the inverse relationship between the price of the fixed income securities and the yield upon the fixed income securities. I'll repeat my point, though it is not a session on fixed income, but just to give you the basic so that you guys know that even the risk-free securities or government securities or treasury bills can also default, right? So there is a concept of duration. It talks about the inverse relationship between the price of the fixed income securities and the yield on that fixed income securities. That is, when the yield rises, the price of the fixed income security fall. When the yield falls, the price of the fixed income security rises. So, if the yield rises in the market, if the yield rises in the market, it can be due to many reasons. It can be due to some monetary policy, that the RBI or the US central bank increases the interest rate in the market due to some inflation concerns, right? It might be some geopolitical tensions, some macro events which get priced in the interest rates automatically. वहां पे गवर्नमेंट को कुछ नहीं करना, वहां पे सेंट्रल बैंक को कुछ नहीं करना. इट्स द मार्केट सेंटिमेंट. The market sentiment gets priced in the interest rates, then geopolitical tensions, some long-term inflation expectation, tariff की वजह से, right? There are some long-term inflation expectation, macro tensions, geopolitical tensions that gets priced in the interest rates. And to price that risk, to accompany that risk, the interest rates, the long-term interest rates, or the medium-term interest rates in the market automatically tend to rise. There can be other reasons for that, but just to keep it generalized. Okay. So when the interest rates in the market are rising, the price of these bonds, these government bonds, treasury bonds, जो superly secure हैं, it will come down. It will come down, though they won't default. But there's always a price risk, right? Similarly, when the interest rates go down, the price of the fixed income securities will tend to rise. सो जब भी हम फिक्स इनकम सिक्योरिटीज के बारे में बात करते हैं ना, अपार्ट फ्रॉम डिफॉल्ट रिस्क, रिस्क का मतलब है रिस्क में डिफॉल्ट भी आ जाएगा, रिस्क में और भी डिफरेंट टाइप्स के रिस्क आ जाते हैं. रिस्क फ्री डजंट मीन डिफॉल्ट फ्री. Two types of major risk which a fixed income security tends to suffer apart from default risk is your price risk and reinvestment risk. You might have heard about this if you are a student of finance. Price risk or reinvestment risk. What is price risk? If the yield on my fixed income security is rising on account of any of the reason, be it monetary, be it fiscal, be it sentimental, be it geopolitical, or any other macro condition, the price of my bond will fall. My portfolio, if I'm holding some bonds, I, I might be getting some interest rates. I'm happy. Instead of 5%, I'm getting some 6%, 7% now. But when a 100 ka bond has come down to 90 rupees, my portfolio ideally is there a mark to market loss. MTM losses, we tend to call them MTM losses, mark to market losses. My portfolio is in losses because my portfolio's performance is not entirely being driven by interest on the fixed income securities, because that I'm getting directly into my bank account. It's also not being driven by dividends, because I'm not reinvesting my dividends, that the dividends on equity is hitting my bank account ideally, right? So my bond portfolio is suffering a mark to market loss and it might be in red. So that's a price risk. But on the other side, if the interest rates go down, if the yields go down from 6% to 5% or 4.5%, the market price of my fixed income security will rise due to the concept of duration. Backend dynamics we'll try to understand later or watch in the modules. ऐसा क्यों होता है? Why this inverse relationship is there? It's more of a demand and supply issue, right? So if the yield is falling, the price of my fixed income security is rising. My portfolio is very happy. It's in green. My bond prices have risen from 100 to 110 to 115 to 120. But I'm getting a lesser yield now. So if I sell my bonds in the market now, if I sell my bonds, my fixed income securities, treasury bonds, or any of the bonds in the market now, and purchase some new bonds, I won't be getting that 6% interest rate now. I have to manage with some 5% or 4.5% interest rate. So me getting a lower yield is a reinvestment risk. So bonds suffer these two types of risk. Now, you might question that if we are trying to save this price risk, then we might lose at the reinvestment risk. But if you're trying to save the reinvestment risk, we might lose at the price risk. We can't save both of these together, or we can't make our fixed income security completely price risk free and reinvestment risk free. We can up to a certain extent. There are certain bond management strategies, right? Three or four strategies are there: bond dedication, immunization, right? Bond laddering. Different kind of strategies are there that is there already in my curriculum of fixed income and equities. Refer that, you'll understand about the fixed income in a much broader way, right? But as of now, since we are focusing on the financial modeling discussion, I'll keep it point oriented, to the point oriented. ठीक है? That is a risk free security. So from a conceptual way हमें इतना पता चल गया है कि अगर मार्केट में कोई भी बोल रहा है रिस्क फ्री सिक्योरिटीज आर रिस्क फ्री, दे कैन नॉट डिफॉल्ट, दे हैव नो रिस्क, even though also have risk, but the risk will be less than corporate bonds, right? But if we want to make these securities entirely risk free, right? If we want to make this number actually risk free, having a zero probability of default, we need to adjust this number. We need to adjust this number. Currently, if I talk about India, in India, a 10-year bond yield as of now, as of today, is giving approximately some 6.53%. You go to Google, like, right, that number is available publicly. You type on Google, go to Chat GPT. Like nowadays, you have Chat GPT. Current India 10-year bond yield rate or bond rate, it will give some 6.5% approximately, some decimals here and there. US Mint is 4% as of now, the 10-year treasury bond yield. ठीक है? अब if I talk about India, तो इंडिया में if I want to calculate the cost of equity for my financial model, right? Because this will become the input of my WACC. In the previous session, we talked about WACC, right? What is WACC? WACC stands for weighted average cost of capital, or the overall cost of capital, or simply the cost of capital. Your cost of capital, it tends to encapsulate both your cost of debt and cost of equity. We talked about a specific formula. हमने पूरे फॉर्मूला की बात करी थी प्रीवियस सेशन में, मैं यहाँ पे फिर से लिख भी देता हूँ कि वैक का फॉर्मूला क्या होता है. इट्स योर कॉस्ट ऑफ इक्विटी इनटू द वेट ऑफ इक्विटी plus your cost of debt into your weight of debt adjusted with taxation, because debt always enjoys the benefit of tax deductibility of interest. This formula के बारे में we talked in the previous session. नहीं देखा है देख लो, डाउट है पूछो. ठीक है? DU dive, we talked about this formula and I promised you to decode these terms in the next session, and that I'm doing it here today. ठीक है? फॉर्मूला समझने के लिए प्लीज रेफर माई प्रीवियस सेशन और रिकॉर्डिंग्स और यूट्यूब वीडियो. ओके, तो अब यहां पे these to become the inputs. If I do not have my cost of equity, if I do not have my cost of debt, I cannot calculate WACC. I cannot calculate WACC, right? It stands for weighted average cost of capital. सो इसमें ये रिस्क फ्री रेट जो है इन योर कॉस्ट ऑफ इक्विटी, रिस्क फ्री रेट जो है इन योर कॉस्ट ऑफ इक्विटी, so basically what do I need to do? I need to adjust this number because many people in the market will use that number of 6.5% here directly. They will directly use this number of 6.5%. वो बोलेंगे कि 6.5% हमको मिल रहा है ऑन गूगल, कॉपी पेस्ट कर दिया, बट दैट इज रॉन्ग. दैट्स एब्सोल्युटली रॉन्ग. Many of the people in many investment banking firms, Indian investment banking firms, are making this mistake. That they are just copy pasting that 6.5% number. No, we need to adjust this 6.5% number. I'll go down. Hmm. So the cost of equity is RF plus B into RM minus RF. RF को हम decode कर रहे हैं. So this RF, वैसे you have to subtract something which is called as default spread. From RF, you have to subtract something which is called as default spread. As the name suggests, default spread. It is the probability of default, or it is the percentage which we believe by which that fixed income security or the government security can default. So risk free rate we know as 6.5%. India का current default spread, India's current default spread is approximately 2.5%. India's current default spread is approximately 2.5%. So 4% becomes our adjusted risk free rate. So now the question might come, how to calculate default spread? सर आपने ये 2.5% का नंबर कहाँ से बता दिया? हमको तो पता नहीं है. सी, और क्रिजल और इकरा, राइट, or all the rating organizations, you go to Google and you type default spread country wise. Just go to Google. And go to Google right now. Default spread country wise. Right? Even Ashwath Damodaram also calculates default spread for different countries. All the countries in the world. So CRISIL, ICRA, S&P, Moody, Fitch are giving you default spreads, calculated numbers. You need not calculate that. One way is taking from there, automatically copy paste. Because those are tried and tested numbers, calculated numbers. वो कुछ भी numbers नहीं डाल रहे हैं. Right? They've gone through various models, which you learn in FRM. You also learn a part of that in CFA. Right? But not everything you have to calculate now. If even if you are a CFA, even if you are an FRM, that doesn't mean that if something is there with you free of cost publicly, you will still calculate it. And you will show that you are a CFA and I need to calculate the number. मैं show नहीं. जो चीज़ publicly available है, free of cost available, then why would you calculate? Nowadays, Chat GPT, if you type on a Chat GPT, it will give you the exact similar number what is S&P and the other rating organizations are giving you in their PDFs. है तो वहां से भी you will get the exact number and this will change year by year. आज 2.5 है, हो सकता है पिछले साल 2% हो, आगे जाके शायद 1.5 हो जाए या 3% हो जाए. It will differ. This 2.5% won't remain standard. One way to calculate default spread, I will tell you, the most simplest way is take the yield on a corporate bond and take the yield on a government bond and take the difference. So if a corporate bond is giving me some 10% interest rate, if a corporate bond is giving me some 10% interest rate and the government bond is giving me 6%, or a corporate bond is giving me 10.5% and a government bond is giving me 6.5%, or it can be such a way, see, if a corporate bond is giving me 10%, or if in this case, what I can do, I can just simply do, if a corporate bond is giving me some 8% and the government bond gives me 6.5%, then my default spread, it comes out to be like 1.5%. Correct? In this case, I can take a 9 minus 6.5 अगर मुझे इस नंबर को justify करना है. But now the question that might come into place is 6.5 का number I have it already, which corporate bond to take into account, right? So usually what happens in case of corporate bonds, you can take any of the company's corporate bond because the corporate bond will definitely give you some 1.5 to 2% minimum higher than the government bond. HDFC का corporate bond उठा लो, ICICI का corporate bond उठा लो, right? टाटा मोटर्स का उठा लो corporate bond. it will definitely give you some 1 or 2% higher, right? So usually what happens, the corporate bonds in the market and the government bonds in the market, the difference between them is not usually, I'm talking about the base case scenario. High yield bonds will give you some 15-16%. ठीक है, वो नहीं लेने हैं इसमें. I'm just talking about like good quality investment grade bonds. Will always give you some 2 or 2.5% higher than your government bonds. तो किसी भी कॉर्पोरेट बॉन्ड का ले रहे हो, और इंडिया में यू ऑल्सो हैव अ कॉर्पोरेट बॉन्ड इंडेक्स. You also have a corporate bond index in India, right? So the corporate bond index in India is giving me some 8%, 9% odd as of now, which it is giving, right? So I can just take the difference and get my default spread. That's the most simplest way to calculate default spread. Now, there are some other ways also to calculate default spread, right? There is one formula to calculate default spread, which is a bit complicated. इसमें हम नहीं जाएंगे. It says the credit default spread into 1 minus recovery rate. The CDS, the credit default spread into 1 minus recovery rate. ये एक फॉर्मूला है, एक्सेप्टेडली फॉर्मूला है, right? But you need not get confused by it. The simplest way is take the number from a rating agency or take the difference of a corporate bond or a government bond. और this is the way where they tend to use assign some weights. ठीक है, इस फॉर्मूला पे अभी कंफ्यूज मत होना, बिकॉज गूगल माइट गिव यू दिस फॉर्मूला ऑल्सो, राइट? इसकी बात अभी हम नहीं करेंगे. यू नीड नॉट गेट कंफ्यूज्ड. तो अभी के लिए just take the difference or take the number normally. So this is the way you calculate your risk-free rate. This is the way you calculate your risk-free rate. अब दूसरा कंपोनेंट आता है this B, right? So remember guys, always adjust this RF, adjusted risk-free rate. Then you have the component which is called as this component, and this component is called as beta. This B stands for beta. Now, what is beta? Before understanding beta, we need to understand the difference between systematic risk and non-systematic risk. Non-systematic risk is also called as unsystematic risk. बात एक ही है, ठीक है? Systematic risk or non-systematic risk. There are two types of risk in the market. One is a systematic risk, and the second one is a non-systematic risk. Firstly, let's try to understand the non-systematic risk or the unsystematic risk. Unsystematic risk is also called as diversifiable risk. Non-systematic risk is also called as diversifiable risk. It is that risk which you can diversify away by creating a portfolio. Simple logic. If during COVID time, if anybody had invested just into hospitality companies, hotel companies, tourism companies, QSR companies, his portfolio would have been completely negative. His wealth might have eroded. But if someone also had a composition of IT industry, also had the composition of metallic industries, pharma industries, his portfolio would have been fairly decent or superly positive or making some superlative returns, extraordinary kind of returns. Correct. So this is that risk which can be diversified by creating a portfolio. There might be some company specific issue. There might be some promoter driven issue. There might be some internal company issue. But if you have a set of good quality companies, 10 companies or 20 companies in your portfolio, and two or three or five of them do not perform, but the other 15 companies or 12 companies outperform the market, still you are into a decent shape or a mindset, or a portfolio is into a decent growing trajectory. राइट, कि दो तीन स्टॉक ने चलो अच्छा नहीं करा परफॉर्म, वो कंपनी बेकार हो गई, या प्रमोटर अच्छा नहीं था, कंपनी की अर्निंग अच्छी नहीं आई, बट बाकी स्टॉक्स वर गुड, एंड बेस्ड अपॉन दैट स्टॉक्स योर पोर्टफोलियो इज स्टिल इन ग्रीन, यू आर स्टिल मेकिंग some decent returns in the market or beating the benchmark. So the return that you can diversify by stock selection or some allocations into the right asset class, equity में कितना जाना है, कितना fixed income में जाना है, कौन सा stock choose करने हैं. So based upon that, that is the non-systematic risk or the diversifiable risk. And then you have something which is called as systematic risk. But systematic risk is something which is non-diversifiable. You cannot diversify that risk. Why? because it's not company specific, it's not portfolio specific, it's not a promoter driven specificity, right? It's more of macro driven issues, interest rate issues, some geopolitical tensions, some war, some tsunami, some COVID kind of thing, some depression kind of thing. So all these things is something that even if you create a portfolio of good quality companies and stock, and the economy is going down altogether, the economy is going into a depression, the economy is undergoing a kind of recession, some war is going on, like for example in Ukraine, Russia, now they have attained ceasefire. But just to try to give you some example, even the good quality companies will crash. Even fundamentally good quality promoter driven companies or good quality earning companies or cash flow companies again will go down. They will crash because you cannot control that. And that is your systematic risk. And systematic risk is being denoted by what? Your systematic risk is being denoted by beta. Beta is a proxy for systematic risk. Systematic risk is also called as your market risk. Systematic risk is also called as your market risk. Non-systematic risk is also called as your idiosyncratic risk. Idiosyncratic risk. Non-systematic risk is also called as idiosyncratic risk. Right? That is also we need to understand. So beta is majorly a proxy, right? Beta is majorly a proxy for systematic risk, right? Also, one more thing. For systematic risk is also called as the relevant risk. Systematic risk is also called as relevant risk. And your non-systematic risk is also called as irrelevant risk. ठीक है, तो सिस्टमैटिक रिस्क को हम मार्केट रिस्क भी कहते हैं, हम रेलेवेंट रिस्क भी कहते हैं, राइट? एंड नॉन सिस्टमैटिक रिस्क को हम आइडियोसिंक्रेटिक रिस्क भी कहते हैं. वी ऑल्सो कॉल इट एज इररेलेवेंट रिस्क, राइट? राइट. एंड वी ऑल्सो कॉल इट एज यूनिक रिस्क. ठीक है. तो सिस्टमैटिक रिस्क हुआ, चाहे नॉन डाइवर्सिफिएबल रिस्क हुआ, मार्केट रिस्क हुआ, रेलेवेंट रिस्क हुआ, it is just and the same. But if we talk about the non-systematic risk, it's your diversifiable risk that you can diversify by creating a portfolio. It's also called as idiosyncratic risk. It's also called as irrelevant risk. It's also called as irrelevant risk. It's also called as unique risk. Whereas systematic risk is also called as your market risk. It's also called as your relevant risk. And diverse and non-diversifiable to hai, right? Now, beta, if we talk about beta, the various ways to calculate beta, right? That will calculate in Excel. Once we create that financial model, a separate tab is there for you to calculate beta, right? We might be using some regression, we might be using some slope function in Excel. So different formulas are there to calculate beta. वो हम कर लेंगे, ठीक है? उसकी कोई प्रॉब्लम नहीं है. Now, the thing that comes into place is there are two types of betas: aggressive beta, and the second one is a defensive beta. Aggressive beta, and this I'm telling you against the market. Against the market, there are two types of betas: aggressive beta and defensive beta. Aggressive beta is something which will be more than one. Defensive beta will be something which will be less than one. And what do I mean by that? If the beta is more than one, assumingly 1.5, it means if the market rises by 1%, the stock will rise by 1.5x. That is 1.5 into 1. तो ज़्यादा से बढ़ेगा, right? But if the market falls by 1%, your stock will fall by 1.5%. So in a rising market, aggressive beta is good. But in a falling market, it can hamper the returns. For defensive beta, assumingly your beta is 0.5. So if the market is rising by 1%, right? Your stock will only rise by 0.5%. But if the market is falling by 1%, your stock will fall by just 0.5%. So in a rising market, it's not good. In a falling market, it's saving your portfolio. And the number you get over an annual basis, ये तुम daily basis या monthly basis पे you can't judge beta. Annual basis, correct? Beta of index is always one because we are comparing our stocks or portfolio with the index. Beta of Nifty 50, Nifty 500 will always be one because market को market से compare करोगे, it's nothing. You are comparing your stock or portfolio with the market performance because you want to beat the benchmark, right? If Nifty 50 gives you a 12 to 13% CAGR over the last 10 years, you want to get more than 12 13% by investing into good quality portfolios, some mutual funds, or good quality stocks, right? So that is the case. Okay. So वो चीज समझना is very important. Now, many people tend to have a combination of aggressive betas plus defensive betas. Some people who just have defensive betas aren't able to beat the benchmark over long term. That's a study. ये मैं खुद से बना के नहीं बोल रहा. And this thing you can judge by your own also. If the market is rising, because over a long term, the market always rises. Over a 5 year period, 10 year period, 20 year period, equity markets are always positive. There might be some volatility, there might be some drawdowns, some riskiness in a 6 month period, in a 1 year period, in a 2 month period. But over a 2 year, 3 year, 5 year, 10 year, 20 year, 30 year, equity market always gives you positive returns. Correct? So if you are going for a defensive beta portfolio, you won't be able to beat the benchmark. If you go as a combination of aggressive and defensive, you might beat the benchmark or you might be at par with benchmark. But if you go with the aggressive strategy, in a short term, the strategy might be highly volatile, highly risky. There might be huge drawdowns as well, 15, 20%, 30% even. But over a long term, 2 year, 10 year, 20 year, 25 period, if you are a long term investor, if you have that appetite to take risk, your portfolio's final return shall be significantly higher than the benchmark, will beat the benchmark. So, aggressive beta portfolio is a strategy for those people who can take the risk in the market, who can digest the drawdowns of more than 20 30% in the portfolios. But if you cannot, go for a combined beta portfolio, but never for a completely defensive portfolio. मार्केट में पैसा नहीं बनेगा फिर. ठीक है. दैट इज द लॉजिक. अब from a company perspective, there can be further two more types of beta. One is a leverage beta or the levered beta. Second one you have as the unlevered beta. So as the name suggests, the levered beta has the component of debt and the unlevered beta doesn't have the component of debt. ठीक है. How to calculate levered beta, how to calculate unlevered beta is something that we will learn. There is a specific formula where you adjust your beta with debt and taxation and weighted average cost of capital and calculate the levered beta, right? So levered beta has the component of debt. इसमें कंपनी का debt included है. Levered beta is also called as equity beta. Levered beta is also called as equity beta. Unlevered beta is called as asset beta. Unlevered beta is called as asset beta. You might be a bit confused कि बीटा में डेट ले रहे हैं डेट नहीं ले रहे, क्या लॉजिक है. बट वंस यू अंडरस्टैंड थिंग दिस थिंग while creating a financial model, you will understand it better. A beta which doesn't have the component of debt is unlevered because beta is a measure of market risk. Na, you are comparing your stock against the market and your stock is a combination of equity and debt. एंड मार्केट का जो इंडेक्स है उसमें जितनी भी कंपनीज हैं दे आर ऑल्सो कॉम्बिनेशन ऑफ इक्विटी एंड डेट. So that's a holistic comparison, apples with apples. Correct? So a leverage beta or an equity beta, also called as equity beta, will have debt into it. Whereas an unlevered beta, also called as asset beta, will not have debt into it. Right? So this is something used when we are projecting the company's financials. Just to tell you as an overall, because in the subsequent session, we shall learn how to project these betas, how to use all these things practically on Excel. ठीक है. अगर आज मेरी कंपनी का डेट टू इक्विटी is 1.5, 1.6. If I plan to reduce it to 0.7 to 0.6 in the upcoming 5 to 6 years, right? Hear these concepts because if my current debt is 1.2, 1.3 debt to equity, and I want to reduce my debt to equity to less than 1, to zero point 0.7 to zero point 0.8 in the next 5 years. So that 1.2, 1.3 is my current stage. It's my levered beta. I'll be using my levered beta, right? बट अगर मुझे वो 0.7 0.6 करना है इन द नेक्स्ट 5 6 years, and financial modeling is based upon forecasting, upon the future projections, I cannot use this 1.2 1.3. I'll have to use a zero point 0.7 zero point 0.6 at a point of time in my calculation, not initially but at a point of time. So there I will remove my 1.2 ka impact from beta and add my zero point 0.8 ka impact on beta. Might sound a bit tricky, but we'll do it practically that time. ठीक है. अब the last component, this one, this RM is the return on market. RF is same as the risk-free rate. RM is the return on market, and it is the return on index, not on particular stock. The return on index Nifty 50 or Nifty 500. So if Nifty 50 has given me, and here we take like 10-year average numbers. All these numbers are taken. See, the risk-free rate is something that you take as of now. 6.5 है तो 6.5 ही लेना पड़ेगा. Beta, again, it's a past 10-year का data you take, an average beta you take here. How to calculate that we learn. RM you take an average equity 10-year CAGR. Nifty 50 average 10-year CAGR has been approximately 12.5%. So 12.5 minus 6.5 कर दिया, ठीक है, 6% का रिटर्न आ गया. So this is something called equity risk premium. This bracket is called as equity risk premium. This difference is called as equity risk premium. And what do we mean by equity risk premium? That is, you have taken additional risk in the market to make additional return. Because in case of the risk-free securities, which are absolutely risk-free now, because we have adjusted the risk-free rate by subtracting the default spread, by deducting the default spread, you are taking negligible risk in the market. You might be getting some 4%, 5%, 6.5% in India, which is really good. But if you go to equity market, you get more than 6.5%, some 10%, 12%, 13%, 14% at the index level. So you have taken additional risk in the market to go into equity and make the return, correct? And that is the difference. That is what equity risk premium. But this is not the exactly the many people tend to use it. I'm not trying to I would say disregard this method of calculating the equity risk premium, right? But the thing is, it is not exactly the most appropriate way, right? It's not completely wrong, but there are multiple improved ways to calculate equity risk premium. There are multiple improved ways to calculate equity risk premium. One major way that is used, though there are multiple ways, I'll suggest one more additional way, like which is being used popularly, or which is the most appropriate way to be used in the market. ठीक है. इसमें क्या करते हैं हम? How many you know about the dividend discount model? The dividend discount model. BBA में they teach BCom honors, MBA. Do not worry about that. ठीक है. What happens in a dividend discount model? The formula says D1 divided by PO plus G. D1 expected return, D1 divided by PO plus G. D1 is the dividend, expected dividend. I'll try to decode this formula more. That is majorly DO into 1 plus D divided by PO plus D. How this D1 has been calculated, it is DO, that is your current dividend. How much growth I am expecting in my company's dividend. Yeah, if I'm researching upon a company, right? If the company is paying some dividend as of now, right? What is the current dividend into 1 plus growth rate? That is the expectation of the earning growth rate. That is not the expectation of the dividend growth rate, the earning growth rate. In India, as of now, we are expecting the earning growth to be between 7 to 8% for this year, right? Not more than that. Right, so maybe a number of 7 to 8% can be taken here if we take at the index level, but here we are doing it for the company, for a specific company's earning growth expectation. And that is something you get on a chat GPT or a Google or the analyst report. What is the expectation of the company's earning growth? That will also do. वंस वी डू द एक्चुअल क्रिएशन ऑफ द फाइनेंशियल मॉडल ऑन एक्सेल, वो हम करेंगे, राइट? सो बेसिकली here you get your D1 divided by PO, that's your current share price, the current share price in the market. You go to stock exchange as of today, BSE, NSE pay, whatever the share price, you take it here. Plus again the earning growth rate. So this value and this value will be same, correct? So basically what happens, this becomes your dividend yield plus your earning yield. Ideally, dividend divided by the current share price क्या होता है? It's your dividend yield. Right, we learned about the financial ratios in the very first session, second session or third session. Dividend yield plus earning yield. You add both of these, you add both of these, you get something which is the expected returns on equity. You get something which is the expected return on equities. अगर हम दोनों को ऐड करा, एक सेकेंड, I'll just erase the below stuff. Hmm. So your expected return minus your risk-free rate, it will give you your equity risk premium. Your expected return minus the risk-free rate, it will give you your expected risk premium. I'll give you one example. Let's go down. Just assume that the company pays, that the company's current dividend yield is 1.5%. Expectation of company's earning growth, that is PAT growth, is 8%. Then my expected return on that company's stock, it comes out to be 9.5%. 9.5% is my expected return on the company's stock. I subtract 6.5% out of that because that is my risk-free rate. I need to subtract that to get my equity risk premium. Right? I get 3. So 3 comes out to be my equity risk premium. So that number I can just take directly and plug it and try to multiply it with beta. वो ब्रैकेट का पूरा नंबर ही मेरे पास आ गया 3%. So my dividend yield plus earning yield is giving the expected return on the equity. इतना तो मुझे मिलना चाहिए बिकॉज मार्केट फॉलो अर्निंग ग्रोथ. जितना स्टॉक का रिटर्न बन रहा है उतनी कंपनी की अर्निंग ग्रोथ एंड डिविडेंड ग्रोथ भी होनी चाहिए. आइडियली ज्यादा हो सकता है स्टॉक का रिटर्न, बट as an intrinsic comparison, as a fair value comparison, if earnings and dividend yield together they grow by some 20%, stock price should also rise at least by 20% to have a fair set of comparison, apples with apples. So that is the underlying assumption. And then you subtract the risk-free rate and get the equity risk premium of 3. अब यूएस का करंट एक्विटी रिस्क प्रीमियम कितना चल रहा है? यूएस का करंट एक्विटी रिस्क प्रीमियम इस 5% के आसपास चल रहा है. इंडिया का अराउंड 7.4 7.5 के आसपास चल रहा है. 7.4 7.5 के आसपास चल रहा है, राइट? अब नाउ लाइक व्हाट दे हैव डन आइडियली, if you try to understand the numbers again, that number can also be derived via this. If I see इंडिया का 6.5 तो मुझे पता है. द डिविडेंड yield is around 1.5 in India, right? Earning growth over a long term period, you see around between 12 to 15% रहता है. I take 13% here. 13 plus 1.5, it gives me like 14.5. I subtract 6.5 from here, right? Approximately I get some 8% around. Right? तो this number will keep on changing. This number will keep on changing. अगर मैं इस नंबर का मैं 12 लेता, राइट, तो 13.5 हो जाता, देन मेरा आंसर मैच कर जाता अराउंड 7.5%, एंड दैट इज द इक्विटी रिस्क प्रीमियम फॉर इंडिया. यूएस में डिविडेंड्स थोड़े कम हैं, राइट, अबाउट 1.1 के आसपास कुछ डिविडेंड यील्ड चल रहा है, राइट. अर्निंग ग्रोथ वो कितनी बोल रहे हैं? हाउ मच इज द अर्निंग ग्रोथ इन यूएस? equity earning growth, anybody can tell me, even if I take this 1% as dividend yield. Expectation is not much more, not more, is not much more, around 7-8%. 8% भी मैं ले लूँ, 9% is the expected return, minus US का 10-year bond yield is 4%, right? You get some 5% odd as the equity risk premium. This is the way they're trying to calculate. Ab, the problem that comes into place is this equity risk premium that you get here, you need to adjust it as well. You need to adjust this as well. This equity risk premium, the two formulas that we studied, like one was basic, एक difference ले लिया, and one was via the dividend growth model. ठीक है. अब इस equity risk premium को भी we have to adjust. We have to add a country risk premium to it. We have to add a country risk premium to it because a company is also being driven by country's risk. If my company is very good but country is very bad, my company will be impacted by that, right? So I need to take into account the way I adjusted my risk free rate, I subtracted my default spread, right? इसमें I will add my risk premium of the country because ultimately my risk will, in that case of risk free rate, my major agenda was to exclude my risk, and that is why I subtracted my default spread. In this case, I want to show the risk, the exact risk, the total risk which is there while investing into that particular company. So I will add my country risk premium. Now, this is something which is complicated to calculate. How do we calculate country risk premium? हम country risk premium कैसे calculate करते हैं? So our country risk premium is being calculated as a mature country's equity risk premium. फॉर्मूला बता रहा हूं. प्लस volatility of the emerging market equity index divided by the volatility. This is a standard deviation का measure, right? Emerging market का debt index into default spread of your country. Into default spread of your country. That's your country risk premium. That's your country risk premium. And once you calculate that, you add it to ERP. The question that comes into, see, this number, as of now is 2.1. And default spread इंडिया का अप्रोक्सीमेटली 2.2 2.3 के आसपास चल रहा है. 2.2 2.3 के आसपास चल रहा है. द प्रॉब्लम इज, सी, स्टैंडर्ड डेविएशन ऑफ द इमर्जिंग मार्केट इंडेक्स. तो इमर्जिंग मार्केट इंडेक्स जो है अपना MSCI EM का स्टैंडर्ड डेविएशन यू कैन टेक, एंड इमर्जिंग मार्केट बॉन्ड इंडेक्स का स्टैंडर्ड डेविएशन यू कैन टेक. You can simply divide that, but you need not calculate that also. These numbers are given to you freely on ChatGPT or Google or rating websites. The problem that comes, mature countries equity risk premium. Here we take US as a standard country. इसका 5 चल ही रहा है. That becomes 5 plus 2.1 into 2.2. 5 plus 2.1 into 2.2. And what number we get here? 2.1 into 2.2 plus 5. 9.62. Correct? That number comes out to be 9.62. So you add 9.62 what? To your country's equity risk premium. To your company's equity risk premium. So if my equity risk premium of my country is 3, 3 plus 9.62. So around 13.62 is the adjusted equity risk premium for my company. An equity risk premium for my company. And that is where cost of equity is always higher than cost of debt. Because equity shareholders bear the major brunt of the company's downfall. उनको फिक्स इंटरेस्ट रेट भी नहीं मिलता, और जब कंपनी का डाउनफॉल फाउल आता है, दे गेट नथिंग, राइट? सो दैट इज द वे यू कैन सिंपली कैलकुलेट equity risk premium of a particular stock company and add it to the country risk premium. बट अगर कॉस्ट ऑफ इक्विटी इन जनरल निकाल रहे हो, इन जनरल फॉर इंडेक्स, राइट, देन सिंपली व्हाट यू कैन डू, इन जनरल अगर निकाल रहे हो देन हमको पता है कि 5% का नंबर है ही, मतलब इंडिया के लिए लाइक 7.4 7.5% का नंबर है ही, एंड दैट 7.4 7.5 का नंबर जो हमने अभी किया डिराइव, इवन इफ यू टेक दैट 12 13% का निफ्टी का रिटर्न एंड सब्ट्रैक्ट दैट विद 6.5%, तब भी उतना ही आता है, अराउंड 7.4 7.5, राइट. सो बेसिकली और CAPM मॉडल जो क्या है ना, इज ट्राइंग टू एस्टैब्लिश एन इक्विलिब्रियम रिलेशनशिप, or trying to establish a relationship between your cost of equity and systematic risk. Last line for today. If someone asks you that what exactly is the CAPM model, it tries to establish an equilibrium relationship between the cost of equity and the systematic risk. That's it. Any questions, anybody? Any questions, anybody? If no more questions, we can end the session and let's get back to one more interesting session next week about actually creating the financial model on Excel. Thank you so much, guys. Thank you.